On its Q2 earnings call, Netflix management tamped down recent engagement concerns and also addressed revenue growth, programming strategy, distribution, AI's role, and more. Listen on.
Welcome to this week's edition of Inside the Stream. This is Will Richmond from Video News, and that, of course, was Colin Dixon at the top from N-Screen Media. Colin, how is everything for you?
It's going good, Will, and we are going to break a rule and we sort of have between ourselves that we don't talk about the same company in two consecutive podcasts, because we talked about Netflix trying to YouTubeify itself last time, and this time, well, we've just sat in on the Q2 earnings call for Netflix, and boy, it was made for interesting listening, right?
Yeah, a lot packed in that 30 minutes, and we're going to try to parse through the highlights today, just to give listeners a cue on how this is going to go. 5 main areas of discussion. Number 1, engagement. Number 2, revenue growth and monetization. Number 3, programming, strategy and spend. Number 4, distribution and platform opportunities. And number 5, features and new services and innovation. So we're going to explore all those in some depth, and we're going to try to do it all in 30 to 35 minutes. So here goes.
I think we can get it done. Let's get going with engagement.
Well, engagement, of course, has been the big topic over the last week or two because of the Bloomberg news that Netflix was experiencing this pretty significant drop-off from season 1 to season 2 in viewership. And you and I talked about that last week. We agreed that it was a little bit hard to understand the specific data points being shared. And I think that Netflix management was really on the hot seat today to try to address how real the Bloomberg data and the experience actually is. So a headline here is that they said that in terms of season 1 to season 2, there was no material drop-off in the aggregate. In the aggregate, no material change. Now, that doesn't address the specific question of whether specific shows experienced significant drop-off or not. But in the aggregate, they said no material drop-off. And they also said that there's not necessarily a linear relationship between viewership hours and revenue and profitability. Actually, let me just pause and step back for a second. So I think job 1 for management today was to address whether the engagement challenge, the engagement issue is real or not. That was job number 1. And I think our reaction to that was that they addressed it by saying that in the aggregate, this is a non-issue. This is not something that deserves the level of attention that it's received, and that they have their own internal viewership metrics that are highly refined over many, many years. And that's what they're really focusing on in terms of measuring the value to viewers and how this translates to revenue, profitability, churn, et cetera. And that they're satisfied with where things are. Is that fair to say that was your interpretation as well?
I think that certainly was. I mean, what Ted Sarandos had to say was a bit confusing, because he then went on to say later that our season 2 fall off has improved over last year, after saying that on aggregate there really wasn't a drop off. It's a bit confused, but as you say, I think the point that you made was that they would pretty much be obligated to state that there was a season 2 drop off if there was, since there has been so much press about this in a material drop off. Yes, they would have had to have admitted that there was a material drop off.
Yeah.
So yeah. And
so, and I think maybe just last thing worth mentioning here is that, again, as I just said, just to add to it, that Greg Peters, co-CEO, said that they're not going to disclose specific viewership metrics that they use internally, but that they, in his words, geek out about these metrics and track them closely, and they've really evolved. And also that not all content is of equal value. And we'll talk about that in a couple of minutes when it comes to programming and spend. But, impression I was left with was that nobody has a more sophisticated understanding of how their content is performing than the management does. And so we all need to be, I think, a little bit careful about overreacting to specific data points that are in the media.
Yeah, I think so. And there was some information in the watch reports, which, by the way, they're cutting back from half yearly to yearly, which I'm a bit disappointed about. They keep giving us less and less information on how specific content is doing. But I took a quick look to illustrate some of this. First, the show Nobody Want This. There was a massive drop-off for that show between season 1 and season 2, from 56 million views to 31 million views. And then you look at a show like Lincoln Lawyer, which has done remarkably well through its runs. Season 2, Season 3, and Season 4 pulling in, between 32 and 35 million. Solid. It's really been solid performer. So that just really illustrates it's a show by show thing. That could be the big drop off. Could just be that people lost interest in Nobody Wants This, or a lot of people did lose interest in Nobody Wants This, and they haven't in Lincoln Lawyer. So
right, and
it's
again,
a show by show thing.
Right, we don't want to undercut our own takeaway here, which is that we're taking management at its word that in the aggregate there wasn't a material drop off season 2 from season 1. We're, obviously management may revise its opinion next quarter. One never knows, but that's what the record is currently. So let's go ahead and move on. Revenue growth and monetization, Colin.
Yeah, so revenue growth was pretty good. It came in line with what I think the financial community was expecting. They've seen a 12% on a quote FX neutral basis growth in revenue to 12.6 billion over the same quarter last year. And so that's pretty good. The one thing I will say, Will, is that Craig Spence pointed at two drivers for this. One was organic growth in subscribers, and the other one was price increases, which he sort of mentioned really quickly, flying by. But if you look at what happened in the US in the last year increased the price pretty considerably. There was about a 12% increase across all plans. And so, US is 30-40% of Netflix's overall revenue. My suspicion is a lot of this 12% year-over-year increase is actually due to price increases, not due to 12% growth, say, in subscribers. So that's the way that looks to me. But overall, revenue growth is pretty solid, and certainly the numbers don't suggest that there's been a lot of subscribers leaving even though there's been this price increase. It looks like most members have swallowed the price increase, and that's in fact what they did say during the call, was that they've seen things behave pretty much the way they have in the past when they've increased prices. So yeah, pretty strong revenue growth over last year.
And I'll just add a couple of things that stood out for me. Of course, we've been talking about the ad-supported tier that they launched several years ago. A number of times here on the podcast, they noted today that the average revenue per member on the ad-supported tier remains below what it is on the ad-free tier. So they see that gap, making up that gap, as a big opportunity. How are they going to make up that gap? They mentioned, they really seemed to point to improvements in their ad tech, being able to tap more demand sources, better ability for buyers to transact, targeting, etc. They certainly, I think they reiterated the guidance about $3 billion of advertising revenue this year. And also, I think relevant here is that they really highlighted how quality, variety, and quantity of programming is what really feeds the revenue and profitability cycle. And to that point, and we'll talk about this a little more when we talk about innovations, but they're also pulling some levers on things like free trials, testing ways of introducing premium tiers to new members in particular geographies. So it seems like there's some innovation that's happening that could drive further membership growth and revenue growth and possibly reduce churn going forward.
Yeah, it's interesting, isn't it? And one of the things that, that makes it, I think, quite hard for them to get the revenue up to on ad-supported viewers to the same level as non-ad supported is because they keep increasing the difference. In the last price increase, they increased the price difference between ad and no ad subscribers from $11 to $12. So that's a big chunk of change that they have to make up every month to even that up. So makes me wonder why they're pushing so aggressively by raising rates so much on ad-free viewers to try and get them to watch ads when they're making less money. I don't get that, why they're driving so hard at that.
Right, and we know that Netflix has the biggest gap between ad-free and ad-supported viewing tiers of any streaming service in the industry. And, we don't know the specific answer, but I think that it's probably fair to say that they think there's more growth to be had on the low end of the market, in the ad-supported part of the market. So they want to keep that as attractive as possible and try to make up the gap in ARM by driving more ad revenue. So we'll wait and see. But let's go on to the third category, as I outlined at the beginning, which is to talk about programming and spending on programming. So top line here is the reiteration that they invest in programming behind revenue growth. So this has always been kind of a mantra of Netflix, is that they want to see revenue growing before they get too far out on the spending on content. They said this year content spend will be up 10% versus last year. That compares with an average of 8% during the past 5 years. So they have accelerated a little bit. There are also, I thought, some really interesting commentary here about programming strategy. So first thing that they noted a number of times is that live programming has been a major source of subscriber acquisition for them. 6 of the top 10 acquisition days have been big live programming, live content days. No doubt those are all sports related, World Baseball Classic, NFL, etc. Those must have been certainly among the top 6 acquisition days for them. They also noted that with the recent Home Run Derby, they're really starting to drive the value that the intersection between live programming, creator programming, and premium programming. The illustration here was Home Run Derby. They had featured Hot Ones, which is a new creator program that they've brought over, and also The Hawk, which is the new Will Ferrell show. So I don't know the specifics on that, but they highlighted that there's an intersection between these content types that they are going to be exploiting. They were asked about the possibility of launching a FAST service, free ad-supported TV. We know that's been popular. In fact, we just saw, I think this week, Fandango lean into FAST further. We've talked about other services in the past. Sounds like they are remaining open to it, but no, as they put it, no near-term move on that front. Also worth noting that they mentioned video podcasts seem to be performing well. You and I talked about that on the podcast previously. And the idea of meeting members where they are. This is helping drive daytime viewership, helps on mobile. And also recurring theme here that they said was that not all content has equal value. So I think you had the data on that one, Colin.
I do. And they to illustrate that, they talked about live, which they say consumes about 5% of the content budget, but attracts only 1% of viewing hours, and animation, which also consumes about 5% of the content spent, and that drives 8% of viewing hours. And I guess your comments there on live being the top type of content to attract new users is a great illustration of the why live is so much more valuable than say animation, and why it's worth spending that much extra for it.
Agreed. And I think it might be worth just pausing here for a moment to, I think, really observe and remind listeners, as long as you and I have been following Netflix and understanding how they've had this tremendous success story that they've had, is to really understand how they've used data to drive their programming strategy. That continued to be a through line in this call with management today. We've talked in the past about how, in the early days of how Netflix was choosing which packages of content to bid on from studios and networks, that they had this, I remember specifically we talked about this asymmetric advantage that they had, in the sense that they knew very well how certain types of content would perform on the service because of past practice. And that really drove how they would want to spend and how they wanted to bid on various projects. And, I think we continue to see that flowing through how they're allocating spend on live, sports, premium content, creator content, original licensing, etc. Netflix has been really, really savvy about using its data, really leveraging its data to drive its content strategy. And it seems like it's continuing to do that now as it branches into a greater variety of content types. Again, we've seen it now with the video podcast. We've seen it with the creator content, with the publisher content, with short form content. The list goes on and on. Yeah. Having that data is key to their success.
Yeah, absolutely.
So let's go on. Some talk also today about distribution and platform opportunities that I know is near and dear to you.
Yeah, I just want to touch on this. I think listeners may remember that we talked about Netflix's TF1 deal in France. TF1 is a major broadcaster in the French market, and Netflix has inked a distribution deal with TF1 where all of the TF1 content is available within the Netflix experience. I assume that they've got some sort of ad split exchange going on here. So TF1 gets paid for the content. TF1 maintains its brand. The big win for Netflix here is more content brings people into the Netflix client more. So there's very little information. Craig Peters wasn't drawn on this. He said it's only been in market for 4 weeks, so they really don't have that much. All he would say is that they're pretty pleased with the way it's going so far, that obviously members are finding that content and beginning to watch it inside of Netflix. The reason I'm mentioning it, Will, is because I believe this is Netflix's greatest growth engine going forward. I can only think of one other video client that has better reach than Netflix, and that's YouTube. And Netflix is primarily a premium reach in the television market. I think this is an area that they're going to lean into pretty heavily going forward. So watch them to look for more TF1-like deals in France. I also think they might start to partner on a reseller basis, even much as Amazon has with channels and the Roku channel has with partners, where they actually help sell add-on content services within Netflix. So I think that's a great opportunity for them, and they're a completely untapped resource that they will lean into going forward.
Bold statement there. Quote, greatest growth engine going forward. You heard it here first from Colin Dixon. Not sure I completely agree with that, but I do agree, a big unexplored value driver for them, no question about it.
Yep.
Okay, well, let's go on. And we want to talk about this category. We're just going to kind of umbrella category of new features, new services, innovations, etc. And let's start with what they talked about with cloud gaming and kids gaming. Do you want to kick that off?
Yeah, so they've been investing in this business now for a couple of 3 years. They still talk about the fact that it's very early days. They say it's a very big opportunity. I think they said 150 billion opportunity. I think that might be the whole size of the gaming market, which I don't think they're going to dominate anytime soon, but it is a big opportunity. However, they've launched a couple of specific efforts that I think are bearing fruit for them. They say that they have launched cloud gaming. So cloud gaming, of course, allows for multiple people to play together in a single experience. And they say they have seen 11 times growth since last October in monthly active users. And they also say something similar for kids. Well, not quite as big a growth, but since launch, they've seen a 2x growth in monthly active users for kids content. And of course, kids content is ultra safe on Netflix. There's no in-game purchases. There's no in-game advertising. So it's really a safe place for you to put your kids. So really solid growth there with Netflix. I have to say, I am using a couple of Netflix games on my mobile devices, and the thing that keeps me there the longest, Will, is no annoying ads. So, if you are already a Netflix member, it's a great benefit. The casual games are a great benefit. If you like casual games, you should check them out.
And I am actually not much on casual games, so I think you're talking to me when you make that pitch, and maybe I will indeed try it out. But clearly, to your point, they were very enthusiastic about the growth in the game side of the business. Seems
very
like
much so.
They mentioned getting real signals, positive signals in both areas, high retention value, and seems like that's going to be an area for greater investment. But speaking of area for greater investment, kind of wrapping up the call, they talked about the role of AI in the business. And they acquired an AI company called Interpositive not long ago, and were asked about what impact it's having. I thought some very interesting comments there from Ted Sarandos. AI, they said, is now being used across the full production life cycle. Mainly, it sounds like in post-production, but also in other areas as well. He said it's being used in 300 different titles in the catalog currently. His quote was that they are getting things done with AI at twice the speed and half the cost, and specifically referenced a documentary series where 17 minutes were completely AI generated. And specifically, he called out where AI is being used to create complicated shots and sequences, such as historical battle scenes that in the past simply would not have been done because they were just too expensive to create, and they would have been left out of the production. And to the extent that they added value to the overall viewer experience, they would have not been there. So theory being here that AI is adding value to what the output actually is. In fact, I think that's what he said, higher quality output. So he also said that the cost savings from using AI are likely to be reinvested in the business, and that in some way is now creating the AI is now in some way creating a revenue profit flywheel for the company. So some early insights from management there about the role of AI. And of course, we all know that AI has gotten so much attention in the media and entertainment community about what impact it's going to have, particularly on the creative side of the business. And there are certainly no shortage of doomsayers out there that worry that AI is going to completely put the creative aspect of the business out of business, if you will, take it out of the equation. I think what we are hearing today is that AI is additive to the creative and the overall production process, and that companies that are savvy about how to integrate it are probably creating some real competitive advantage for themselves as we speak. And of course, you and I and others outside can't exactly quantify or particularly understand in the specifics how that's being done, but certainly that was I think the directional nature of management's comments today about AI, which I took as being quite bullish actually for the opportunity with AI, for AI in the creative process, and maybe calms some of the fears of the doomsayers.
And bearing in mind that they now claim to be the biggest creator of premium content in the world, AI potentially has an opportunity to be tremendously additive to that success, right? So that sort of begs the question. So you sort of poo-pooed my TF1 deal as being a leader of the biggest opportunities. Do you view AI as the leading opportunity?
Yeah, I do. I think AI. Yeah, I really do. I think AI is the biggest. I mean, longer conversation, but I've become more and more optimistic, shall we say, about how AI can be used ethically going forward in all different types of places. But again, I think it's going to take some work, right? And the doomsayers will still get a lot of airtime, but I think it can be done. But we'll see exactly how. But I just, as we wrap up here, Colin, I think a couple comments to make. One is something that struck me was, again, management at Netflix, they have shown over and over again how well they run their business, not without hiccups, to be sure. We don't want to give them a complete hall pass here because there have been hiccups, but overall, company has been very well run. Definitely a different era in terms of streaming right now. The easy pickings have been had. So it's now very much about a share battle and who can innovate and who can monetize. So that, I think, those are really the key challenges in front of Netflix. And of course, again, a lot of headlines about engagement, season 2, season 1 drop off. But ultimately, I think we have here really a bet on management's ability to navigate the ship through this new period that streaming is in. And we need to wait and see. But there will be a lot of moving pieces going forward, right?
And talking about the doomsayers, I was just quickly looking at the stock, how Netflix's results and the call with investors was received, and I would suggest that the doomsayers are still in the majority. The stock is down from about 74 to 68. A big $6 drop off in just the last few hours since that call.
Well, our listeners know we're not here to talk about stock prices and whether to buy stock or
no,
that.
Certainly not. But I'm just using it as a sort of gauge of how people received Netflix's results and how people received the call.
Fair points. I mean, and that's after hours today. We're recording on Thursday, of course. We'll see how it performs tomorrow, Friday, when the market opens. But as management reiterated yet again, they do not manage the company to quarter performance. They manage it on an annual performance. So there will always be volatility along the way. And they, again, I think want to be judged on an annual basis. But of course, as we've talked about in the past, that's getting harder and harder to do because they're disclosing less and less data. They took the watch report down from semi-annual to annual today. They stopped reporting subscriber numbers. What's next?
They'll give us a
revenue
hint.
Any longer.
They'll give us a hint at where the revenue is. But I think that's probably about enough for today, Will.
Fair point. Okay, good chatting, Colin. A lot of ground covered here. And thanks, everyone, for listening in.
Inside the Stream is a production of In-Screen Media and Video News. All rights reserved.